Hello, and welcome to the Robert Half Fourth Quarter 2020 conference call. Our hosts for today's call are Mr. Keith Waddell, President and Chief Executive Officer of Robert Half, and Mr. Michael Buckley, Chief Financial Officer. Mr. Waddell, you may begin.
Thank you. Hello, everyone. We appreciate your time today. Before we get started, I'd like to remind you that the comments made on today's call contain forward-looking statements, including predictions and estimates about our future performance. These statements represent our current judgment of what the future holds. However, they're subject to risks and uncertainties that could cause actual results to differ materially from the forward-looking statements. These risks and uncertainties are described in today's press release and in our most recent 10-K and 10-Q filed with the SEC. We assume no obligation to update the statements made on today's call. During this presentation, we may mention some non-GAAP financial measures and reference these figures as adjusted. Reconciliations and further explanations of these measures are included in a supplemental schedule to our earnings press release. In addition, we'd like to remind you that beginning last quarter, we modified our presentation of revenues and the related growth rates for Accountemps, Office Team, Robert Half Technology, and Robert Half Management Resources to include their inter-segment revenues from services provided to Protiviti in connection with the company's blended staffing and consulting solutions. This is how we measure and manage these divisions internally. The combined amount of divisional inter-segment revenues with Protiviti is also separately disclosed. The supplemental schedules just mentioned also include a revenue schedule showing this information back for 2018, 2019, as well as 2020. For your convenience, our prepared remarks for today's call are available in the Investor Center of our website at roberthalf.com. Fourth quarter results for both our Protiviti and staffing operations were very strong and exceeded the top end of our guidance range. Protiviti reported its 13th consecutive quarter of year-on-year revenue gains, with particular strength in its technology consulting practice and managed solutions with staffing. Our staffing operations reported broad-based, double-digit, quarter-on-quarter sequential revenue growth on an as-adjusted basis. I could not be more proud of our teams have managed through this extraordinary year. Over the past several months, they've made significant impacts helping our clients succeed and job candidates find meaningful work. Company-wide revenues were $1.304 billion in the fourth quarter of 2020, down 15% from last year's fourth quarter on a reported basis and down 16% on an as-adjusted basis. Net income per share in the fourth quarter was 84 cents compared to 98 cents in the fourth quarter 1 year ago. Cash flow before financing activities during the quarter was $85 million. In December, we distributed a 34-cent per share cash dividend to our shareholders of record for a total cash outlay of $39 million. We also acquired 1.1 million Robert Half shares during the quarter for $63 million. We have 9.9 million shares available for repurchase under our board-approved stock repurchase plan. Return on invested capital for the company was 31% in the fourth quarter. Now I'll turn the call over to our CFO, Mike Buckley.
Thank you, Keith, and hello, everyone. Let's start with revenues. As Keith noted, global revenues were $1.304 billion in the fourth quarter. This is a decrease of 15% from the fourth quarter 1 year ago on a reported basis, and a decrease of 16% on an as-adjusted basis. On an as-adjusted basis, fourth quarter staffing revenues were down 24% year over year. U.S. staffing revenues were $723 million, down 25% from the prior year. Non-U.S. staffing revenues were $219 million, down 23% year over year on an as-adjusted basis. We have 326 staffing locations worldwide, including 88 locations in 17 countries outside the United States. In the fourth quarter, there were 61.7 billing days, equal to the number of billing days in the fourth quarter 1 year ago. The current first quarter has 62.3 billing days compared to 63.1 billing days in the first quarter 1 year ago. The billing days for 2021 by quarter are 62.3, 63.4, 64.4, and 61.7 for a total of 251.8 days, which is approximately 1 day less than 2020 due to it being a leap year. Currency exchange rate movements during the fourth quarter had the effect of increasing reported year-over-year staffing revenues by $8 million. This increased our year-over-year reported staffing revenue growth rate by 0.7 percentage points. Temporary and consultant bill rates for the quarter increased 2% compared to a year ago, adjusted for changes in the mix of revenues by line of business. This rate for Q3 2020 was 3.1%. Now let's take a closer look at revenues for Protiviti. Global revenues in the fourth quarter were $362 million. $294 million of that is from business within the United States, and $68 million is from operations outside the United States. On an as-adjusted basis, global fourth quarter Protiviti revenues were up 18% versus the year-ago period, with U.S. Protiviti revenues up 23%. Non-U.S. revenues were down 2% on an as-adjusted basis. Exchange rates had the effect of increasing year-over-year Protiviti revenues by $3 million and increasing its year-over-year reported growth rate by 1 percentage point. Protiviti and its independently owned member firms serve clients through a network of 86 locations in 28 countries. Turning to SG&A presentation. As first noted last quarter, changes in the company's deferred compensation obligations are now included in SG&A, or in the case of Protiviti, direct cost, with offsetting changes in the investment trust assets presented separately below SG&A. As a reminder, our historical discussion of consolidated operating income has been replaced with the non-GAAP measure of combined segment income. This is calculated as consolidated income before income taxes, adjusted for interest income and amortization of intangible assets. For your convenience, we've added another supplemental schedule to today's earnings release on pages 12 and 13, highlighting the impact of changes in the deferred compensation accounts to the summary of operations for the fourth quarter and full year 2020 and 2019. This is a non-GAAP disclosure, so we also show a reconciliation to GAAP. Turning now to gross margin. In our temporary and consultant staffing operations, fourth quarter gross margin was 38.5% of applicable revenues, compared to 38% of applicable revenues in the fourth quarter 1 year ago. The year-over-year increase in gross margin percentage is primarily due to lower payroll taxes, insurance, and other fringe costs. Our permanent placement revenues in the fourth quarter were 9.7% of consolidated staffing revenues versus 10.3% of consolidated staffing revenues in the same quarter 1 year ago. When combined with temporary and consultant gross margin, overall staffing gross margin increased 10 basis points compared to the year-ago fourth quarter to 44.4%. For Protiviti, gross margin was $96 million in the fourth quarter, or 26.5% of Protiviti revenues. This includes $5 million, or 1.5% of Protiviti revenues, of deferred compensation expenses related to increases in the underlying trust investment assets. 1 year ago, gross margin for Protiviti was $90 million, or 29.7% of Protiviti revenues, including $2 million of deferred compensation expense, or 0.7% of Protiviti revenues, related to investment trust activities. Company-wide selling, general, and administrative costs were 32.6% of global revenues in the fourth quarter, compared to 32.8% in the same quarter 1 year ago. Deferred compensation expenses related to increases in underlying trust investments had the impact of increasing SG&A as a percent of revenue to 2.7% in the current third quarter and 1.2% in the same quarter 1 year ago. Staffing SG&A costs were 39.7% of staffing revenues in the fourth quarter versus 36.7% in the fourth quarter of 2019. Included in staffing SG&A costs was deferred compensation expense related to increases in the underlying trust investment assets of 3.7% and 1.5%, respectively. We ended 2020 with 7,800 full-time internal staff in our staffing divisions, down 32% from the prior year. Fourth quarter SG&A costs per productivity were 14.1% of productivity revenues compared to 17.1% of revenues in the year-ago period. We ended 2020 with 7,300 full-time productivity employees and contractors, up 34% from the prior year. Operating income for the quarter was $89 million. This includes $41 million of deferred compensation expense related to increases in the underlying investment trust assets. Combined segment income was therefore $130 million in the fourth quarter. Combined segment margin was 9.9%. Fourth quarter segment income from our staffing divisions was $79 million, with a segment margin of 8.4%. Segment income for productivity in the fourth quarter was $51 million, with a segment margin of 13.9%. Our fourth quarter tax rate was 27% for both the current and prior period years. Accounts receivable at the end of the fourth quarter, accounts receivable was $714 million, and implied days sales outstanding, or DSO, was 49.4 days. Before we move on to first quarter guidance, let's review some of the monthly revenue trends we saw in the fourth quarter of 2020 and so far in January 2021, all adjusted for currency and billing days. Our temporary and consultant staffing divisions exited the fourth quarter with December revenues down 20.8% versus the prior year, compared to a 23.8% decrease for the full quarter. Revenues in the first 3 weeks of January were down 23% compared to the same period 1 year ago. Permanent placement revenues in December were down 25.4% versus December of 2019. This compares to a 28.5% decrease for the full quarter. For the first 3 weeks of January, permanent placement revenues were down 20% compared to the same period in 2020. We provide this information so that you have an insight into some of the trends we saw during the fourth quarter and into January. But as you know, these are very brief time periods. We caution against reading too much into them. With that in mind, we offer the following first quarter guidance. Revenues, $1.29 billion to $1.37 billion. Income per share, 74 cents to 84 cents. The midpoint of our guidance implies a year-over-year revenue decline of 11.7% on an as-adjusted basis, including productivity, and EPS returning to prior year levels. The major financial assumptions underlying the midpoint of these assumptions are as follows. Revenue growth on a year-over-year basis, staffing down 19 to 21%, productivity up 23 to 25%, overall down 11 to 13%. Gross margin percentages, temporary and consulting staffing 37 to 38%, productivity 25 to 26%, overall 38 to 39%. SG&A as a percentage of revenues, excluding deferred compensation investment impacts, staffing 35 to 36%, productivity 14 to 15%, overall 29 to 30%. Segment income, staffing 8% to 9%, productivity 10 to 12%, overall 8 to 10%. 2021 capital expenditures and capitalized cloud computing costs for the year, $85 to $95 million, with $15 to $20 million in the first quarter. Tax rate 27 to 28%. Shares 113 million. We limit our guidance to 1 quarter. All estimates we provide on this call are subject to the risks mentioned in today's press release and in our SEC filings. Now I'll turn the call back over to Keith.
Thank you, Mike. We enter 2021 with renewed optimism about Robert Half's positioning for future growth. We've retained our key staff, and they are committed to driving our success as the backbone of the enterprise. Our aggressive go-to-market strategy during the pandemic with clients in the public sector and financial institutions of all sizes has yielded meaningful wins and new relationships. Our technology investments have facilitated remote working models internally, and with our advanced AI-driven capabilities are providing clients with real-time choices of candidates from outside their local market area. Owing to its diversified solution offerings, Protiviti continues its record of multi-year double-digit revenue growth and very positive pipeline. The collaboration between Protiviti and staffing is at an all-time high, as evidenced by the 82% year-on-year revenue growth this quarter from the unique blend of consulting and staffing solutions. Staffing services provided to our mid-cap clients now approaches 1/3 of our revenues and growing, and this is incremental to our traditional focus on SMB clients and prospects. With multiple vaccines now rolling out throughout the world and physical and monetary policy support expected to continue globally, economists are increasingly expecting GDP growth to follow. GDP-driven early cycle growth is traditionally particularly robust for SMB clients that are lean and nimble from the downturn and have pent-up demand to restore and upskill their workforce as they return to growth. More than ever, we believe the strength of our brands, our people, our technology, and our professional business model position us for future success in 2021 and beyond. Now, Mike and I'd be happy to answer your questions. Please ask just one question and a single follow-up as needed. If there's time, we'll come back to you for additional questions.
At this time, if you would like to ask a question, press star 1 on your telephone. To withdraw your question, press the pound key. Our first question comes from the line of Mark Marcon with Baird. Your line is open.
Hey, good afternoon, and congratulations. Wondering, can you talk about the opportunities that you're seeing across Protiviti? Obviously, you're accelerating. It seems like there would be a lot of opportunities in a lot of different areas within IT, including cybersecurity audits, particularly in the wake of SolarWinds. And, you did make the acquisition with regards to Identity. So I was just wondering if you could talk a little bit about the areas of growth that you're seeing there and kind of what inning you think Protiviti is in. And then I've got a follow-up for the staffing side.
So the good news for Protiviti is that its success is broad-based. It's led by technology consulting and managed solutions. On the tech side, which we've talked about for a few quarters now, it's cloud, it's cyber, it's privacy, it's digital transformation. In the managed solutions with staffing, it's public sector led by unemployment, housing, education, vaccine. FSI continues to lead with anti-money laundering and consumer lending regulatory actions leading that way. Internal audits down 8 to 10% year on year. Some work got delayed. Some scopes got reduced. There's a little bit of fee pressure. As we've talked about now for a few quarters, Protiviti's pipeline remains very strong. As to which inning we're in, it's clearly not a late inning, because not only do we have macro coming back and discretionary spending that will benefit particularly internal audit. You've also got a new administration in the United States that's viewed to be more regulatory friendly, which is a better thing than not as it relates to Protiviti. So we feel great about where they are, we feel great about their prospects, and we feel like it's early innings.
That's terrific. And can you talk a little bit about the fit with the most recent acquisition and the opportunities there? I know it's really small and just 40 people, but it seems like it would be a really good fit in terms of any sort of IT audits that you're doing.
Well, sure, and identity access management is clearly an important subcomponent of cybersecurity, and we've got a team very expert in a certain platform, a leading platform in that space. So we're happy to have them part of the family. We feel like we can leverage our existing database while we also grow theirs, and we feel good about that as well.
Terrific. And then can you talk a little bit about the staffing side? You know, as we come out of this, Keith and Mike, obviously, we're just in the early stages of inflecting, and nobody knows how long this cycle is going to be. But you're really seeing a nice improvement in terms of productivity. Your headcount was down 32% on the staffing side, revenue down a lot less than that. You've put in place a number of different tools to increase productivity. So how should we think about the productivity over the course of the current cycle as we continue to come out of this? And what I'm wondering is, it looks like you've picked up your hiring, but it's not at a super robust pace yet. So just how should we think about that?
Well, as we've talked for a few quarters now, we've retained our tenured staff. Their productivity is always greater than the less experienced staff. We feel like we've got additional capacity with that group. We think we can leverage that capacity as we grow without adding in an outsized way to heads. There's a little bit of an offset in that our incentive plans are graduated rate plans, hockey stick, if you will. So as these more tenured people get further and further up the hockey stick, some of that leverage will go back to them appropriately so, but we'll still benefit overall, and we expect to have some profitability upside as we continue to grow relative to where we were at same revenue points in the past.
Terrific. Thank you.
Thank you. Our next question comes from Andrew Steinerman with J.P. Morgan. Your line is open.
Hi, guys. Two questions. The first one is, when thinking about that year ago, first quarter of 2020, obviously the month of March was that COVID-affected COVID-affected month. How did you take into that kind of year-over-year consideration when giving first quarter 21 staffing, and when I say staffing, I mean both flex and perm revenue guidance? That's my first question. I'm going to give you my second question at the same time. Then my second question is, how should we think about flex staffing revenues sequentially in the first quarter of 21, recalling that a first quarter is a slower seasonal time for flex staffing?
Well, so your two questions are related. We effectively took our fourth quarter actual results, superimposed a typical sequential progression into the first quarter, and that was the basis for our Q1 guidance. And the year-on-year, Andrew, fell out to whatever it was because we felt like using where we currently are, i.e. fourth quarter, as the baseline for our forecast rather than a year ago, which did have the impacts of that March month in it. We felt like Q4 was a better baseline, and the sequential embedded in our forecast is typical first quarter sequential patterns, temp and perm.
Okay. That answers my question. Could you just give us a sense of if you think temp or perm will do better in the first quarter?
Well, we hope they both do better, and we're just coming off a quarter where they both did a lot better. So we're happy about the momentum that we've had. Our people will tell you it's one of our best restarts to a new year in a long time. So anecdotally, I can assure you the enthusiasm level is very high. That said, we thought it prudent to, given the big step up we had in Q4, to confirm that into Q1 with normal patterns, but not be more aggressive than that.
Well said, Keith. Thank you.
Thank you. Our next question comes from Jeff Silberman with BMO Capital Markets. Your line is open.
Thanks so much. I appreciate you guys giving the headcount numbers like you typically do at the end of every year, and I wanted to focus on the internal staff and staffing. It was down pretty substantially, but again, your revenues weren't down as bad, so we saw some productivity there. What do you need to see to start hiring internal staff in your staffing division? When do you think that'll happen?
Well, as we've said, because we have a more tenured staff and because they have productivity capacity as we speak, we're going to utilize that capacity before we aggressively add more heads. It's good for them, it's good for their compensation, it's good for us. So we don't think, certainly in the next quarter or two, that we'll have to add to staff in a meaningful way, but can still grow nicely as we just showed we could do with the existing staff. I mean, our staff cutbacks were primarily in the second quarter, and so the increases we saw in the third quarter were without any additional staff, and we think there's room to go with who we already have. So I certainly wouldn't take our lack of hiring, either as evidenced by our job postings or otherwise, as any indication that we're not bullish and we don't think we can grow. Instead, we believe there's significant unused capacity of our current tenured staff.
Okay, that's really helpful. As a follow-up, Keith, you pointed out at the end of your prepared remarks about your services to the mid-cap clients, now about a third of their revenues. Can you talk about that? What have you been doing there differently, and what do you think that could be over time? Thanks.
Well, I'd say what we've done differently is a few things. One, we've focused on it. We've had success with it. Two, with Protiviti, with many of those companies and even larger cap companies, we come through the consulting door rather than the staffing door, and by so doing, it's not margin dilutive that it might otherwise be. So the combination of the focus, the success, and the ability to leverage Protiviti and its relationships and its contractual relationships all plays a part. We continue to believe there's upside there. As you know, traditionally we've been principally SMB, and trust me, we're not walking away from SMB. We're not de-emphasizing SMB. To the contrary, we feel like it's the perfect time in the cycle to be SMB. The last couple of quarters, they've been more impacted than mid-cap and beyond. So we've endured the bad side of that, if you will. So now it's time to endure the good side of SMB, and we're excited about how well we can leverage our SMB client base as we've demonstrated in the past. That said, we do think mid-cap is incremental to that. We've done well. We've done it without any net margin dilution, and we continue to invest in that.
Okay, that's really helpful. Thanks so much.
Thank you. Our next question comes from Hamzah Mazari with Jefferies. Your line is open.
Hi, this is Mario Cortellacci filling in for Hamzah. Appreciate the time. Maybe you can just touch on or remind us of your exposure to the travel and leisure industries from a temp staffing perspective. And maybe you can talk about, outside of that, how you think the impact of the vaccine will have on your business.
And so we have very little exposure to travel and leisure. Clearly, that industry is most impacted by the shutdowns and restarts and shutdowns. And so just looking at numbers, there's really no correlation between geography shutdowns because we have so little exposure to travel and leisure. And clearly, the impact of the vaccine can be nothing but positive, while on the one hand, our clients have by and large adjusted to the current environment and have become very virtual. On the other hand, I think everybody's excited about the possibility of not being virtual. And on that score, I thought it was interesting this week we were recognized as a top 20 company in the Fortune 500 for embracing remote work. So we thought that was pretty cool.
Great, thank you. And then on gross margins, maybe you can help us understand or maybe give us a sense for how we should think about gross margins going forward. Obviously, in the quarter, you had some fringe benefits, insurance, things like payroll. But could you give us a sense for some of the puts and takes that you're expecting in 2021?
Okay, let's talk a little bit about gross margin because, first of all, if you look at prior downturns, peak to trough, we've lost 300 basis points in gross margin. Happy to report that this time around, we lost a third of that, 100 basis points. And I'm even further happy to report that we're now back this most recent quarter, we're now back to peak gross margins in our temp businesses. For 2021, given that we are already back, while there might be some upside as we move through the year, we certainly hadn't modeled a lot of upside, remembering that we have the highest gross margins in the industry by leaps and bounds as it is. But trust me, I think one of the things we're most proud of is how we've managed our gross margins, during the pandemic, the height of the pandemic, how we've gotten them back, and how we intend to sustain that into 2021.
Thank you. Our next question comes from Kevin McVeigh with Credit Suisse. Your line is open.
Great. Thanks so much, and congratulations. Hey, Keith, any sense of how the bill rates have been trending in the quarter versus prior quarter and maybe year on year? If you could break that out maybe by segment.
Well, we said in our prepared remarks that they were up 2% year on year, adjusted for mix. That was down a little bit from the prior quarter. It all starts with pay rates, and with higher unemployment, we aren't paying quite as much, still more than we were a year ago, but the rate of wage inflation has subsided to some degree. But all things considered, to still have a little bit of low single-digit wage inflation and then bill rate inflation and protect the margins for the differential is where we are and where we're happy to be.
I understand. And then just real quick, what's the tax rate assumed in Q1 and then for the full year 2021, if you have that?
Yeah, I think it's 27.5%, Mike.
Yeah, it's going to be about the same for the full year.
Yeah. So between 27 and 28.
Okay. Thank you so much.
Thank you. Our next question comes from Gary Bisbee with Bank of America. Your line is open.
Hey, good afternoon. Just wanted to ask another one about Protiviti. So a quarter ago, you told us your expectation was 5 to 7% revenue growth, and it did 18, and obviously you're calling for even further acceleration in Q1. What sort of happened in the last 3 months, and what has, I understand all the areas of strength you've frankly been discussing for several years now, but like what changed there? What's happening, and how maybe durable or sustainable are the drivers of that recent acceleration?
The thing that changed the most is we had more public sector demand right to the end of the year than we expected. We serviced that primarily with contractors, which is why when you look at the supplemental schedules where we break out the inter-segment revenues, you see there was a $30 million spike between quarters 3 and 4, and the lion's share of that was public sector related. Yeah, as to sustainability, the jury's out. That said, we have relationships we've never had before. We've certainly got to look into many local, regional, state governments and their business processes, and we certainly are excited at the opportunity to improve those processes, be it overpayments, a lot in the press about some fraud as it relates to payment of unemployment claims. And so, again, there's no question that there's some spike in that as it relates to elevated unemployment claims that the states are having to process. Same for housing assistance, same for remote learning support for school systems. That said, we do believe, we're confident, and we've got teams put together whose objective is just what you described as far as ensuring the sustainability and leveraging these new relationships that we've never had. Traditionally, our revenues from government-related entities was less than 1% of revenue, so it was almost nothing. So everything we're doing today is virtually incremental.
Thanks. And then do you feel like either through that last discussion you gave or just more broadly how you've gone to market and leveraged the staffing businesses with Protiviti, like who are you gaining share from? You're outgrowing almost everyone else in any kind of consultative type approach we see. Is there a certain place you're taking that from?
Well, I think it's somewhat on the staffing side, and it's somewhat on the consulting side, because neither have the full picture. And there are many staffing firms that can provide customer support people where their client manages them. There are virtually none that do that where we also provide the management, and not only is it the management, it's with a view toward constant optimization, which has been quite the winner. And so, but for us, who would have gotten that work? My guess is some of it would have gone to the consulting firms, the accounting firms. Some of it would have gone to the staffing firms. But none of those players have what we have. And it's actually pretty incredible how well it's done. It grew 82% this quarter. 82%. That's a big number.
Sustainability question for sure, but yeah, no, it was outstanding. Thank you. I appreciate the color.
Thank you. Our next question comes from Tobey Sommer with Truist Securities. Your line is open.
Thank you. Could you tell us what you think the increased exposure to mid-cap clients does to your TAM?
Well, there's no question that staffing at mid and large cap companies is many times the size as the opportunity was smaller businesses. Traditionally, we haven't focused there because margin pressures were such that we felt like we were better off offering our better candidates to small businesses that would pay us for them. But as I said earlier, it's a whole new world when we go hand in hand with Protiviti, and there's the umbrella of an honest-to-God consulting arrangement with honest-to-God deliverables, such that we do think it's a new day, and clearly the addressable market is much larger, which is why we're investing. Think about just during the pandemic, our exposure to mid-cap has gone from low 20% to today it's 34%. That's huge. That's huge, and it's in a small period of time, and it was done in a period where we didn't dilute our margins.
Right. As my follow-up, I wanted to ask you a question on the cost side of delivering your service. Every call we start with talking about the number of locations that you deliver your services to, particularly on the staffing side, but also Protiviti. Are there any meaningful opportunities from the experience in 2020 and now into this year to adjust the cost structure so as to favorably impact margins over the course of a whole cycle?
Well, our biggest cost is our internal payroll cost, and we've talked earlier about we think we've got, with a large assist with the technology we've developed in the last 3 to 4 years, we think our internal staff can inherently be more productive across this entire cycle. Real estate is more nuanced. On the one hand, traditionally, our real estate is very dense. We put a lot of people in our space. There's not a lot of square footage traditionally per person. In today's world of distancing, even post-pandemic, query whether we'll have to relax that somewhat and offset what we'd otherwise save if we're on a hybrid model where everybody doesn't come in every day. So the jury's out on that. I mean, our current thinking is probably more a push than anything, but it's early days, and we don't know. We don't know ultimately how many people are going to want to work remotely versus come in. Excuse me. And further, we don't know whether the density we've traditionally had, which kind of creates an electricity and energy level in an office, which has been helpful. We don't know whether we're going to have to spread people out more for obvious reasons. It's kind of interesting. Australia has some of the fewest number of cases, and so I would argue they're most along post-pandemic, and they've been surprised how much people want to come in and don't want to work remotely. And in fact, they talk about it's 90 to 95% of the staff want to come back into the office. That surprises me. Whether that's sustainable in Australia itself or whether you can replicate that at other places, I don't know. But that's what they report.
Thank you very much.
Thank you. Our next question comes from George Tong with Goldman Sachs. Your line is open.
Hi, thanks. Good afternoon. Revenue trends in office teams stepped up pretty meaningfully in the quarter. What were the main drivers of that improvement, and were there any one-time revenue benefits you'd call out in the quarter in that particular business?
I'd say a couple things. So first of all, fourth quarter, George, office team always benefits from e-commerce customer support, and they got some fourth quarter lift from that again. They also get open enrollment support lift in the fourth quarter. They got some of that again, traditional. But this public sector work with Protiviti that I've been talking about, a lot of that has been customer service driven, call center driven, and office team is the beneficiary of that. Office teams had an incredible couple, 3 quarters. I mean, who would have believed that office team and Protiviti would have gone to market together best at any time, much less during a pandemic?
Got it. Very helpful. You mentioned that revenues in the first 3 weeks of January were down 23% year over year compared to down 21% in December. In which areas did you see the most moderation in growth moving from December to January?
Well, I first think you need to zoom out from that and consider what January post-quarter results mean and what they don't mean. And in fact, if you go back in time and you compare January post-quarter to what, with hindsight, you learn about the entire quarter, it's one of the least predictive post-quarter periods that we have because of the holiday impacts. And so I would tell you that we tend to discount January post-quarter more than most, and therefore the fact that the year-over-year growth rates changed by 3 percentage points, we don't ascribe much importance to.
Got it. Very helpful. Thank you.
As I said earlier, we're very happy with our restart. The enthusiasm level of our people has never been higher, and we got one more week of data this morning, and frankly, it was even better yet again.
Very helpful. Thank you.
Thank you. Our next question comes from Kevin McVeigh with Credit Suisse. Your line is open.
Great. Hey, Keith or Mike, just one follow-up. Keith, when you talk about the public sector work, is that primarily COVID-related work where, you're hoping there'll be some follow-through, or is there any way to frame maybe how much of it is kind of COVID-related that you're looking to kind of, extend once things start to normalize into more normal relationships?
Well, and so it's helping states deal with their unemployment claims, customer service, claims processing, claims adjudication. It's housing, processing assistance claims. It's customer service call centers into that. Education, it's helping school systems deal with tech support for remote learning. The vaccine, again, customer service, call center, people calling in wanting to register. It's helping with check-in. It's helping with the government reporting once it's done. And so it's a whole host of things that clearly are initially related to COVID, if you will. But as I said earlier, it's given us a look into their internal systems, and we think it's a target-rich environment to do follow-up work, which we are very focused on doing.
And that's all state and federal, or a combination of both?
It's more state and local. More state and local.
Is there any way to maybe frame how much that was in the quarter, like in terms of revenue?
Well, we've disclosed to you the staffing, Protiviti, revenue magnitude between the two for this quarter going back. We've told you there was a $30 million lift, and we've told you that a large part of that lift relates to what I just described. So you can kind of use those puzzle pieces and come back to what you're looking for.
Very helpful. Thank you.
Okay, operator, I think that's our last question. Thank you very much, everyone, for participating on the call.
This concludes today's teleconference. If you missed any part of the call, it will be archived in audio format in the Investor Center of Robert Half's website at www.roberthalf.com. You can also dial the conference call replay. Dial-in details and the conference ID are contained in the company's press release issued earlier today.